Between 2020 and 2021, interest rates hit zero, and a tidal wave of retail money flooded the stock market. Millions of new investors logged on, looking for a guide in the middle of a digital gold rush. A charismatic billionaire named Chamath Palihapitiya stepped up to the microphone. He pitched himself as the champion of the retail trader, publicly encouraging comparisons between his own track record and Warren Buffett's. His pitch relied on democratization. He promised to give everyday people access to high-growth, supposedly value-laden investments, famously promoting blank check companies, or SPACs, to take businesses like Virgin Galactic public. But the math tells a different story. As the market turned, everyday traders who followed his advice lost billions. Meanwhile, Chamath quietly extracted hundreds of millions of dollars before the crash. This diagram illustrates what Warren Buffett calls the circle of competence. The concept is simple. True value investing requires deep, structural knowledge of a specific industry's mechanics before you risk capital. Millions of people handed over their savings because they bought into a highly polished narrative instead of doing that deep value due diligence. To understand how that happened, we have to audit his actual track record. The audit starts with his origin story. Chamath frequently cites his early days at the media player startup Winamp, framing himself as a business development genius who helped build out their platform. The founder of Winamp remembers it differently. According to him, Chamath joined well after the company was acquired, and his business deals actively damaged the product, helping drive the project into the ground. He then moved to AOL, rising to vice president by age 26. He points to this as proof of executive skill. Yet his tenure exactly overlapped with the tech giant's steepest historical decline and massive employee firings. His most famous credential came next. He arrived at Facebook to lead user growth, cementing his reputation as a Silicon Valley heavyweight. This diagram shows the mechanics of his flagship project there, a program called Beacon. It tracked private consumer purchases across the internet, like medical supplies or jewelry, and broadcast them out as targeted advertisements without user consent. The blowback was severe. Facebook faced public lawsuits and an immediate drop of over 25 million users before they finally shut the program down. Later, Chamath would publicly reflect on his time there by stating he did a great job. His early tech resume was built purely on proximity to a historic internet boom. A close look at the operational details shows that building software technology was never actually within his circle of competence. During his era as a venture capitalist, we can test his claims of being a disciplined value investor in the mold of Buffett and Munger. In the 1970s, Warren Buffett bought Geico for pennies on the dollar. He made that bet because he possessed a deep, technical understanding of underlying insurance metrics and how they interacted with interest rates. Decades later, as another wave of inflation approached, Chamath promoted a new insurance startup called Metromile. He confidently told retail traders to invest, heavily implying he had the same macroeconomic foresight. This dual-axis chart shows exactly what happened next. As the inflation line rises, Metromile's profit margin line crashes straight to zero. The macroeconomic environment destroyed the company's unit economics. True value investors master the dry, unforgiving mechanics of the assets they buy. Chamath merely imitated the aesthetics of a value investor, without putting in the grueling analytical work required to actually be one. If technology and value investing fall outside his circle of competence, his actual primary skill is the exploitation of market psychology and retail attention. He consistently utilizes information asymmetry. That means leveraging a massive public megaphone to drive up asset prices, all while holding private knowledge about when he actually plans to sell. Take his deal with the financial app SoFi. He went on television to heavily promote the stock to retail traders. Meanwhile, as this timeline depicts, the company's employees were stuck behind a strict 180-day lockup barrier, completely unable to sell their hard-earned equity. Just days before that lockup period expired, Chamath and his partners coordinated a massive sale, extracting over $115 million. When the barrier finally lifted for the workers, the share price plummeted. We see this repeatable pattern in his other highly promoted deals. He dumped his personal stakes in Clover Health and Virgin Galactic near the top, leaving his retail followers to hold the bag as the valuations collapsed. Chamath weaponized populace attention to transform retail investors into his own personal exit liquidity. Today, many of the retail investors who followed his advice are financially devastated. Chamath, still holding on to immense wealth, recently described the multi-billion-dollar destruction of his followers' capital as a blessing that taught him a personal lesson. When you confuse a popular social media narrative with actual financial truth, the result is often sudden and absolute ruin. A charismatic story is not a substitute for value, and public virtue signaling is not a financial fundamental. This analysis is for educational purposes. The only real protection against financial Pied Pipers is strict, independent research and a commitment to your own due diligence. You can start tracking real market temperatures today using the Buffett Indicator app and join the deepvalues.ai community to access objective, noise-free deep value intelligence.